Welcome to BusinessTraining.com and our video on vintage returns. This video will help you to understand the basics of what a vintage return is and when it is paid out in a private equity transaction. One must first differentiate between two commonly misused terms. The definition of a vintage year is a year in which the first influx of investment capital is delivered to a project or company. This marks when capital is contributed by venture capital, private equity fund, or a partnership drawing down from its investors. Vintage returns are the years of the highest returns within a private equity investment. An example of how vintage returns works can be seen in the recent financial turbulence. For the private equity investors who could make new deals, historical data suggests that 2009 and 2010 could be good vintage years because there is an inverse correlation between the state of the global economy and the returns from private equity investments. Essentially, investors get the best returns from investments they made during the worst economic cycles and during economic recessions, as there is less competition for deals and asset valuations tend to be significantly lower. The time the initial investment is made is a vintage year. Investors can use a vintage year of an investment to further explain its returns. Having a vintage year occur at the peak or bottom of a business cycle can affect the later returns on the initial investment. During peaks in the market, new companies are more likely to be overvalued based on the current economic outlook. This increases the expectations on an investment's return because more money is initially contributed. Inversely, companies are typically undervalued during low points in the market. Because less capital is initially contributed, these companies or products have less pressure to generate big returns. Vintage returns mature in the later stages of a private equity life cycle. This is when the private equity fund has had time to invest its capital, see the underlying companies grow, and is now reaping the benefits of these investments in its vintage years. For example, many private equity firms have been drawing down capital from investors over the past 3 years in anticipation that the mortgage meltdown was a signal of vintage years for them to make investments. The investments they made will require time and possibly more investments to mature. When we have entered a new bull market or possibly before, those investments will start to come to fruition, and this is when the vintage returns will occur. In essence, vintage returns are when the initial investment, made in the vintage years, has matured and is then realized and distributed to investors. Thank you once again for your time and attention, and this is BusinessTraining.com, where you can earn a master's level qualification to make more money.